Ladies and gentlemen, welcome to Only Trade to Win. I do not know where the market is going tomorrow or the next week, and I also don't have any buy or sell recommendations for you. But what I do have is a methodology that took 25 years to put together. And the intent of this show is to share with you how a professional trader thinks so you can implement it in your own trading and investing and become profitable on your own. Today is Thursday, February the 1st, 10 a.m. New York time. We have lots of earnings today. Apple, Amazon, our comeback champion from 2023, Meta is reporting today. Here is our long-term picture of Apple looking back from 2018 till now. Look at this little pullback here. We're sitting at the top. Yeah, earnings are coming out today, and look at how confident the investors are. The stock is sitting near its all-time high. I think Apple's biggest value is its loyal client base or customer base. It's not the phones or the computers that they sell. So the last 3 shows we worked on semiconductors. Here is the list. These are the 7 largest companies in the Philadelphia Semiconductor Index. I had a huge awakening after putting right here column number 5 and column number 7. Here I have earnings per share growth from January 1, 2023 till January 31st, 2024. So basically from beginning of last year when we started this huge rally until now. And if you look at these stocks, obviously Nvidia is number 1, AMD number 2, Broadcom number 3, Intel number 4 in terms of earnings, and we go 330% all the way. Texas Instruments is the only one that is negative. But one of the things that we noticed after doing all these numbers, that if you look at the earnings per share increase and the revenue increase compared to the stock prices increase, then you have I have a lot of questions. It's when a stock goes up 113% like it did for Broadcom, but the earnings per share go up 6% and the revenue goes up 4%. I'm not really sure about the valuation. Now look at Taiwan Semiconductor. Their earnings per share dropped 23% compared to the last quarter of last year, and their revenues dropped as well. So going down below, we're looking at the 7 largest companies in the Philadelphia. We're looking at 7 largest companies in an index right here, Philadelphia SOX, that was up 70% last year. That's compared to our leader Nasdaq at 53. So it definitely outperformed Nasdaq. Yet if we take a look at the earnings of the largest companies in the Philadelphia Semiconductor Index, not only have they not gone up, they actually have gone down, and some of them have gone down quite significantly. There could be a lot of different scenarios. One could be that after COVID, we had such a backup in supply chain. Then last year, when they did clear out that backlog, they had huge numbers that came in, and now compared to those numbers. Another possibility is that artificial intelligence is definitely a new and hot industry, and maybe they're trying to squeeze some pork and run up these prices as high as possible, unload, maybe get short. But if you look at fundamentals, I don't really see anything except Nvidia. Look here, earnings per share up almost 600%, revenue more than doubled. Prices up 330%. Oh, great. Still has more room to go because they earned it. But what about everybody else? Look at all these duds. They're not going anywhere. Philadelphia Semiconductor. And after seeing a disaster like this in the top 7 stocks, I was wondering what's going on with the rest of the Philadelphia Semiconductor Index. And since we have only 30 stocks, I went ahead and I added them to our spreadsheet. Okay? Here they are. I was trying to fit them all in one page, but it's not going to happen. So here's stock appreciation, or in case it's red, stock depreciation for last year and 1 month. Now, if we look at the performance of individual stocks inside of the index, we notice that everything is positive except Texas Instrument, Wolf Lightning, Coherent, and Lattice Semiconductors. All other stocks appreciated last year. So now we need to fill in the changes in earnings per share and our revenue. And here we go. Here are earnings per share. And let's do revenues right away. Okay, and here we go. Earnings per share. The biggest loser is Wolf Lightning. We're going to go and look at their picture for sure. Wow, Rambus. The stock is up 100% and its earnings per share are down 42%. Okay, this one is down and down. Okay. So if we take a look at earnings per share for the rest of the stocks that are components of the Philadelphia Semiconductor Index, we can see that majority of them have seen their earnings per share drop. And the same picture is on the revenue side. Down, down, down. And though, it seems like the revenues are not as much down as the earnings per share for majority of these companies. Here, suddenly one even here. Seems like it's become really expensive to run the business for every company but NVIDIA. So right now I'm going to play with numbers. Okay. So the biggest loser, Wolf Lightning, you can see that numbers match. Their biggest loser. And then the second biggest loser is up here. Okay. Are you guys seeing what I'm seeing? Can you please comment below? Do you see that the stocks are appreciating at the rate that the fundamentals are not supporting? You see, there is a huge disparity when the stocks and companies are seeing double-digit drops like this in revenues and earnings per share. Their stock goes up. This one clock 57%. Here we go, another one. ENTG. Earnings per share are down 20%, revenues down 10%, but the stock is up 80%. Here we have another one, Marvell. Revenues are down 8%, earnings per share are down 28%, the stock is up 88%. So first of all, one thing that we can clearly see is that in this case, fundamentals do not drive the appreciation. And the second thing, that the expectations also do not drive this rally, because this is not what people expected last year when they were buying these stocks this aggressively. And sometimes when we get into a bull market, the tide lifts everything. But one thing with semiconductor index is that it doesn't look like the fundamentals are driving this market. And if you are investing in semiconductor stocks, you really got to take a hard look and make sure that you are keeping companies that are making money. NVDA, QRVO, and that's pretty much it. Why buy a lot of losers when you want to go for leaders? But look at this thing. Actually, QRVO is a good example. Their earnings per share are up 180%. Their revenue is up 44%, but the stock is up only 11%. Let's rank it and see what it is. Okay, here we are. 1, 2, 3, 4, 5, 6, 7. Seventh place from the bottom. Second place in terms of performance, and number 25. 2 in terms of earnings, number 25 in terms of performance. And that is exactly why we look at the pictures, because if we look at the fundamentals, if we look at what's going on here in our spreadsheets, we definitely say, look, these numbers are not supporting this rally. And if we take a look at the individual companies, we can definitely see this appreciation. Here is 69% for Applied Materials. Here's our 170% for Advanced Micro Devices, 57% for CLAC, 80% for Lem Research. You get the picture. We have stocks that are running up these huge numbers, and the earnings per share and revenue is not following. Yet at some point the market will accept the reality. We'll have a situation like Intel that ran up 70% last year. They come out, they beat the expectations, and the stock sells off 15%, which really could be the beginning of the retracement to where it came from last year. And the reason I'm saying that is because if you look at this orange line right here, it shows profitability for the company, growth and profitability. The orange line represents net margins. If 2020, 26%, year 2021, 25%, year 2022, we got 12.7%, and last year the margins for Intel were 3%. And basically the company is almost unprofitable. It's a huge company whose chips are almost in all laptops around the world, yet they're growing their debt. 2019 it was 29 billion, now it's 49 billion. You are increasing your debt, you don't have any margins, and you are paying crazy dividends. Ladies and gentlemen, I think Intel is in huge trouble. And there is a good chance that this whole party, everyone except Nvidia, of course, because Nvidia has earned its price appreciation, but everyone else, especially the companies whose earnings per share and revenues have gone down last year, but their prices appreciated greatly, I think they may be a candidate for a nice sell-off. So this is our fourth and final show on looking at the semiconductors. I know we didn't look at much of pictures today, but I really, after seeing such disastrous fundamental performance of majority, or say let's 6 out of 7 stocks, 6 out of top 7 stocks on the Philadelphia Semiconductor Index, I really was curious, and I wanted to see what's going on with the rest of the industry. And to me personally, it looks weird. It looks weird that companies that are earning money, that are increasing its earnings and revenues, their stocks are not appreciating, while the ones that are losing money, or not losing money, but while the ones whose earnings per share and revenues are going down, their stock prices are appreciating. And I think this whole thing is a big Mickey Mouse right now. And when I say Mickey Mouse, is everybody knows who Mickey Mouse is, but nobody has seen them. And it's the same thing. Everybody's expecting higher earnings per share, higher revenues, bigger margins, but they're not showing up. So let's recap quickly what we learned in the last 4 shows. Our first show, Semiconductors for Beginners, it was a complete introduction talking about what semiconductors are and just a little bit about the industry. The second show, we talked about how to invest in semiconductors. The third show, we looked at the fundamentals behind. And the fourth show, we put it all together. After all, this is our 5th video on semiconductors. We looked at this index from the very beginning, from its inception in 1993 until today. And even though overall this index is really strong, representing companies that are making huge money, it seems like right now there is a big discrepancy in price appreciation and earnings. And that is a red flag. Ladies and gentlemen, until I see you next time, navigate with care.